Ever wondered how market cap weighted index ETFs work? Let's simplify it. Think of the financial market as a bustling city, and market cap weighted index ETFs as the city's tour guide. They are, in essence, a type of exchange-traded fund that gives you a snapshot of the market by tracking an index. But not just any index, these ETFs focus on indexes that are weighted by market capitalization. In layman's terms, companies with larger market caps have a higher influence on the index's performance. The theory behind this is that larger companies are more stable and less risky, thus having a bigger say in the index's direction. It's like the tour guide showing you around the city, focusing more on the popular spots while giving less attention to the lesser-known areas. Now that you have a basic understanding of what market cap weighted index ETFs are, let's delve deeper into some examples. You may have heard of the S&P 500 ETFs, but did you know they are a type of market cap weighted index ETFs? Now let's delve into some popular examples of these types of ETFs. The S&P 500 ETFs are a prime example. They aim to replicate the performance of the S&P 500 index, which is a market cap-weighted index of the 500 largest U.S. publicly traded companies. In simple terms, the bigger the company, the larger its representation in the index. Another significant player in the market cap-weighted index ETF space is the Vanguard Total Stock Market ETF, often known by its ticker symbol, VTI. This ETF tracks the performance of the CRSP U.S. Total Market Index, which is a comprehensive representation of the U.S. equity market, including both large, mid, and small-cap growth and value stocks. Then we have the iShares Russell 2000 ETF, symbol IWM. This ETF tracks the Russell 2000 Index, a benchmark for small-cap U.S. stocks. Unlike its S&P 500 and VTI counterparts, this ETF focuses on the smaller end of the market capitalization spectrum, giving investors exposure to a different segment of the market. And let's not forget about the international market. The iShares MSCI EFE ETF, or EFA, tracks the MSCI EFE Index, a market cap-weighted index of developed market stocks, excluding the US and Canada. This ETF gives investors exposure to a broad range of companies in Europe, Australia, Asia, and the Far East. All these ETFs share a common characteristic. They use market capitalization weighting. This means the weight of each company in the index is determined by its market value, or, in other words, the price of its stock multiplied by the number of shares outstanding. The larger the company, the more sway it has over the index's performance. These popular ETFs are great examples of how market cap weighting works. But what are the pros and cons of this strategy? Tune in for our next segment to find out. Like any investment strategy, market cap weighting has its own set of benefits and drawbacks. As we dive into the world of market cap weighting, it's crucial to understand its inherent advantages. Firstly, its simplicity itself. Market cap weighting involves investing in companies proportionally to their market value. The larger the company's market cap, the larger its weight in the index. This means that as an investor, you don't have to constantly rebalance your portfolio or make complex calculations. The market does the heavy lifting for you. Secondly, market cap weighting is known for its low turnover. Unlike other strategies that may require frequent buying and selling of securities, market cap weighting requires less trading, which can reduce transaction costs and potential tax liabilities. However, every rose has its thorns, and market cap weighting is no exception. One of the main criticisms is its bias towards larger companies. Because market cap weighting gives more weight to larger companies, it can lead to a concentration of your investment in a few big players. This could expose your portfolio to specific company risk and potentially limit diversification. Moreover, market cap weighting is inherently a follower of the market, meaning it automatically invests more in companies as their market value increases. This can sometimes lead to overexposure to overvalued companies and underexposure to undervalued ones. Lastly, it's worth mentioning that market cap weighting is a passive strategy. While this can be a boon for those who prefer a hands-off approach, it can be less appealing for those who enjoy the thrill of picking stocks and timing the market. So to wrap things up, market cap weighting offers simplicity and low turnover, but it also leans heavily towards larger companies and may limit your exposure to smaller, potentially high-growth companies. While there are clear advantages and disadvantages to market cap weighting, it's important to consider how they fit into your overall investment strategy. So, how do you decide if market cap weighted index ETFs are right for you? To answer this question, it's important to consider a few factors. First, take a good look at your risk tolerance. Market cap weighted ETFs, like any investment, come with a degree of risk. These ETFs are usually less volatile than individual stocks, but they still fluctuate with the overall market. So, if you're the type of investor who can't sleep at night worrying about market swings, these might not be your cup of tea. Next, consider your investment goals. Are you investing for long-term growth or short-term gains? Market cap-weighted ETFs are generally suited for long-term investment strategies. They provide exposure to a broad range of companies, allowing you to benefit from overall market growth over time. If you're looking for quick profits, these might not be the best fit. Now let's talk about the investor's understanding of the market. Market cap-weighted ETFs are a great way to gain broad exposure to the market without having to pick individual stocks. But that doesn't mean you can just buy and forget about them. It's crucial to understand what you're investing in. What index does the ETF track? What companies does it hold? How is it weighted? Staying informed will help you make smart decisions and adjust your strategy as needed. And remember, diversification is key. While market cap-weighted ETFs can be a significant part of your portfolio, they shouldn't be the only part. Consider incorporating other types of investments to balance risk and potential return. Finally, don't forget to review your portfolio regularly. The market changes, your goals may evolve, and your risk tolerance might shift. Regular reviews ensure your portfolio stays aligned with your current needs and objectives. Remember, the key to successful investing is understanding your investments. Don't be afraid to ask questions and do your research before making any decisions. Now that we've explored the ins and outs of market cap-weighted index ETFs, let's summarize the key takeaways to keep in mind. First, these ETFs can provide broad market exposure with less volatility than individual stocks. But remember, they're not risk-free. Second, they're typically suited for long-term investment strategies due to their diversified exposure to a range of companies. Third, understanding the market and the specific ETF you're investing in is crucial. Don't just buy and forget. Stay informed about your investments. Fourth, while these ETFs can be an important part of your portfolio, diversification is key. Consider incorporating other types of investments to balance risk and return. Lastly, regular portfolio reviews are essential to ensure your investments align with your evolving goals and risk tolerance. Now that you're equipped with these practical tips, you're one step closer to making an informed decision about incorporating market cap-weighted index ETFs into your portfolio. And remember, investing is a journey, not a destination. So keep learning, stay curious, and don't be afraid to ask questions. Voiceover. As we wrap up this in-depth look at market cap-weighted index ETFs, here are some key takeaways to remember. 1. They offer a less volatile way to gain broad market exposure, but they're not entirely risk-free. 2. They're generally a good fit for long-term investment strategies. 3. Understanding your investments is crucial. Don't set and forget. 4. Diversification is key. Don't rely solely on these ETFs. And 5. Regular portfolio reviews are vital to keep your investments aligned with your goals and risk tolerance. With these tips in mind, you're well on your way to making informed decisions about market cap-weighted index ETFs. Remember, the world of investing is a journey, not a destination. So keep learning and asking questions. And as always, stay curious.